Welcome to Knopman Mark's Series 7 Video Vault. My name is Dave Meshkov, one of the partners here, and I'm thrilled you're joining me to do a little preview of the curated guided Q&A we do in our Vault videos. In this video, I'm going to be breaking down options. We're going to talk muni bonds, taxation, retirement plans, and maybe more. Let's dive in. Required information for options trading. Client expresses interest in engaging in the purchase and sale of put and call options. The client has limited knowledge of options and requests information about the risks and features involved in options trading. Which of the following must a registered representative provide to the client before the client can begin trading options? Great choices here. Does the client need to get an official statement, an options disclosure document, the statement of additional information, or an in-person or virtual educational session to review the characteristics and risks of options trading? What is the requirement for options trading? Well, that rep has to provide the client with the options disclosure document. The options disclosure document is produced by what entity? By the Options Clearing Corporation, of course. The OCC produces the ODD, and it is that required disclosure and actually provides detailed educational and information about the risks and characteristics of options trading. So that choice D, the in-person or virtual education system, it's basically provided in writing through the options disclosure document. And that has to be provided before you begin in options trading. Remember, you can start trading before you sign the options agreement. That's always interesting. But you cannot start trading before you receive the options disclosure document. ERISA regulations. A registered representative is discussing retirement plans with a client who works in the public sector. Which of the following retirement plans would not be subject to ERISA regulations? And before we jump into the answer choices, how effectively can we recall what ERISA does and doesn't cover? ERISA is, of course, that Employee Retirement Income Security Act of 1974, and it governs what kind of retirement plans? Private sector employer-sponsored retirement plans like 401ks, defined benefit pension plans, profit-sharing plans. And what does it not apply to? It typically doesn't apply to plans sponsored by federal, state, local governments, churches, things like that. So with that, let's take a look at the answer choices. Choice A is the 401k plan sponsored by a private company. That was the whole reason they passed ERISA. ERISA was passed because companies were not treating their employees' retirement assets in the ways that they should, ensuring that they were protecting them, not using them. They were not holding them in trust, and ERISA required that. So even if the company failed, the employees' retirement assets would be there for them. You wouldn't get a double whammy, losing your job and all your retirement savings. B, a defined benefit pension plan established by a private sector employer. We see again, private sector, whether it's defined contribution like the 401k or defined benefit pension, in both cases, ERISA applies. C, a retirement savings plan for employees of a state government. Now we're getting into the areas where ERISA does not apply. And D, a profit sharing plan sponsored by a small business. Small business, that's private sector. And so we can see that C stands apart as being a retirement plan sponsored by a government and therefore not subject to the ERISA guidelines. Taxation of dividends. For a mutual fund's dividend to be classified as a qualified dividend and taxed at the investor's long-term capital gains tax rate, that's a nice preferred lower tax rate, which of the following holding period requirements must be met? Details, gang, details. Can you remember what it is? They got some kooky day counts in here. Is it that the investor has to hold the mutual fund shares for at least 61 days within the 121-day period surrounding the fund's X date? Or is it B, that the mutual fund has to hold the underlying stock for at least 61 days within the 121-day period surrounding the X date? So is the holding period of that kooky 61 of 121 looking at the investor in A, or looking at the mutual fund in B, or looking at both the investor and the mutual fund have to meet the 61-day holding period in C? Or does D, the classification depends solely on the nature of the underlying investment, regardless of the holding period? Now, three choices, all circling around that 61 days of the 121 days, numbers that you are familiar with. You remember that they're crooked, kooky numbers, and which, in fact, is the rule? It is C. Both the investor and the mutual fund have to meet the 61-day holding period requirements for a dividend to come out as qualified. So what that means is if you as an investor buy right before the X date, you're going to have to carry that stock over those next 61 days for that dividend distribution to be deemed preferred and enjoy the lower tax rate on it. So remember, for this mutual fund characteristic, both the investor and the mutual fund have to meet the holding period. Municipal bond trades. Which of the following is not a characteristic of a municipal bond? So when you're looking for the not characteristics, it's a little hard to project. There's 1,000 things that are not characteristics of municipal bonds. Which ones are? Well, we want to go through these and make sure we leave the question with 3 known characteristics, because you're just as likely to get a question that's flipped around and they're asking you to identify what is a characteristic. So is A a characteristic of a municipal bond? Most issuances do not trade on a traditional stock exchange, but rather in a decentralized over-the-counter market. Is that a characteristic of the municipal bonds? Yes, it is. Yes, it is. Muni bonds are traded in this decentralized OTC marketplace or a dealer marketplace. If you want to trade your bonds, you have to call up your broker dealer, and they're going to call other broker dealers to try and either obtain or liquidate your bonds or the bonds that you're looking for. What about B? What about B? Most investors have a short to medium term investment holding period with a view towards a sale for a capital gain. Is that a characteristic of a municipal bond? Short to medium term, let's get capital appreciation. No, that is not going to be the primary characteristic or typical characteristic of a municipal bond. Muni bond investors are typically focused on the long-term, stable income generation from tax-exempt interest payments. The whole reason you're accepting a lower yield is because you like the tax advantages, the tax-free interest income that they offer you. The primary appeal of muni bonds is this tax advantage, and it's especially for what kind of investors? Those in the high tax brackets. So there's not typically speculative trading or short-term profits associated with these instruments. Let's just make sure we understand that C and D are characteristics of municipal bonds. C is they're not registered with the SEC, but are fully registered to the investor in book entry form. That's a correct statement. That is a characteristic of muni bonds. They're exempt from SEC registration under what act? Under the Securities Act of 1933. They're issued by states, by cities, by other municipalities, of which, one, we don't think the likelihood of fraud, abuse, manipulation is as great as compared to corporations. And two, there's just a sovereignty issue that the states and other municipalities are independent of the federal government and therefore don't have to register their securities with the federal government. That being said, how are they registered? They're registered to the investor. Now, that's a same word, registered with the SEC, registered to the investor. Registration to the SEC is a disclosure regime under the Act of 33. Registered to the investor just means that the municipality knows who the owner is, and they're registered in book entry form. So it makes it easier for the municipality to make the interest payments. In this book entry form, what is the other piece? Well, the ownership's typically recorded electronically. We don't actually have bearer certificates anymore. So if you go to, for example, Salt Lake City and look at some of the municipal bonds that that municipality has issued, they will have a book or a record of all the owners of the bond. So every 6 months, they can make the tax-free interest payment. It's not who's holding the physical bond. And that's what we mean by book entry form as opposed to bearer form. And denominations of municipal bonds range from 5,000 to 100,000. That is commonly issued denominations for muni bonds. So even though we talk about par value of a bond is $1,000, that's typical on the exam. That's what you'd expect on the exam. The norms in the muni bond space today are for larger denominations starting at 5,000 and moving all the way up to 100,000. This is consistent with why B is wrong. Most investors buy big chunks of these and aim to just hold them. So all of this is all working together. Thanks for watching. I hope I was able to shine a little bit of light on the tough Series 7 topics and concepts that we covered, and maybe share an approach and way to attack the most challenging Series 7 questions that you'll run into. Now, if you like to learn this way with the guided, curated Q&A, be sure you check out our full Series 7 video vault, where I have hours more of content like this on every topic on the Series 7. Best of luck on your exam, and I hope to see you soon.